The markets have been pulling back in the last couple of days, and I want to share with you 3 leaps plays that you can take advantage of, with this possibly being the last opportunity to get in as we head into 2026. In this video, I'm going to share with you 3 setups that I'm most interested in, their ideal entry and exit points, and the optimal expiration dates for the leaps contracts. Hi, my name is Gautam, and on this channel I talk about the stock market and achieving financial freedom with the power of options trading. So if you're someone who wants to build consistent income, retire early, and take control of your financial future, make sure to hit that like button, subscribe to my channel, and share this video with your friends and family. If you are new to the options world and are looking to fast track your learning and avoid costly mistakes, click on the first link in the description below for one-on-one coaching with me, or to join my Discord community, the Launchpad. Inside the Launchpad, you'll get weekly trade alerts, learn how to open, close, or roll trades, master risk management, and even get direct access to me for any questions or guidance. Now, just a quick disclaimer before we get started that this video is for informational and educational purposes only and should not be considered financial advice. I'm simply showing you my trades and how I trade, and I'm not a licensed financial advisor. With that said, let's jump in and get started. If you look at the S&P 500, last Wednesday, Jerome Powell gave us the much anticipated interest rate cut, and right after that news, SPX jumped all the way to 6,900 and continued trending upwards the following day, this past Thursday, touching 6,903. But on Friday, the markets pulled back with the S&P 500 dropping over 1% on Friday. And today the S&P 500 is down 0.18% as we speak at the moment. If you look at where the S&P 500 is trading, it's currently trading in between the top and the middle of the Bollinger Bands, and it's actually very close to the middle of the Bollinger Band. If you look at the middle of the Bollinger Band, which is this green line, that also coincides with this blue line, which is the 50-day moving average. If you look at the RSI for the S&P 500, it's currently at 50, meaning that it's in a neutral territory, meaning that it could possibly go either upwards or downwards based on what happens in the rest of the week. Now, I'm recording this video on Monday, December the 15th, and if you look at some of the major economic events lined up for this week, tomorrow we have the US employment report coming out for November. In addition to that, we also have the US retail sales coming out for October. Obviously, they're delayed at the moment, but it'll be interesting to see because that shows you how the overall economy has been doing. In addition to that, we also have the US services and the manufacturing PMI scheduled to come out tomorrow. On Wednesday, we have a bunch of Fed speeches, including Fed Governor Chris Waller, New York Fed President John Williams, and Atlanta Fed President Raphael Bostic. On Thursday, we have quite a lot of important reports coming out, starting off with the initial jobless claims, consumer price index, and the core CPI report. And on Friday, we end the week with existing home sales and the consumer sentiment report for December. So since we have a lot of economic data lined up for this week, if the markets show any signs of further weakness, I want you to be able to take advantage of that opportunity with the 3 leaps plays that I have lined up in this video. But before we jump in, let's understand what leaps are. So LEAPS stands for Long-Term Equity Anticipation Securities, and these are simply longer dated option contracts going all the way from 1 year to 3 years. So let's talk about why I like LEAPS. One of the primary reasons I like LEAPS is the capital efficiency that they bring about. For example, if Nvidia is trading at $200 today, for me to buy 200 shares of Nvidia would require $20,000 in collateral. In comparison, if I pick up a LEAPS options contract for Nvidia going a year out, I could potentially pick that up for around $5,000, which is basically just 1/4 of the capital that I would require in case I bought 100 shares of Nvidia. Secondly, because you're buying LEAPS options that are 1 year out or longer, time is on your side, meaning that you don't have to have the perfect move, but as long as you enter into a LEAPS play at a time where the stock is beat down or at strong support levels, then you can possibly profit from the stock riding back up and getting to its all-time highs. In addition, the LEAPS play work really well if you go with stocks that are proven leaders with strong fundamentals, good profit margins, and have strong growth opportunity in the time ahead. Now, because LEAPS options contracts are generally 1 year or longer, theta decay really doesn't kick in until the last few months, so you have the opportunity to profit big time if the markets continue to move in your favor once you enter into a LEAPS play. Last but not least, you don't have to perfectly time your entry. Nobody knows the bottom of the stock market, but as long as you believe that you're picking up the stock at a good support point, then you can take advantage of the rebound in the stock with a LEAPS play. So now that you understand all the benefits and pros of entering into a LEAPS play, let's talk about the risk. one of the biggest risks of entering into a leaps options contract is the fact that if the market does not go in your favor once you enter into a leaps play and continues to trend downwards for an extended period of time, then the value of your leaps options contract will continue to fall. And you can lose 100% of the capital that you've invested with that play. So keep that in mind and only invest the amount of money that you're willing to lose. So now that you understand what leaps are, how they work, and the pros and cons, let's jump into my first play, which is actually none other than Nvidia. Look at Nvidia's chart for the past 6 months. Nvidia's been under a lot of pressure over the past few weeks, coming down from a high of 212.19 to today's price $176.44. If you look at where it's trading, it's currently close to the bottom of its Bollinger Band. And for those not familiar with the Bollinger Bands are a technical analysis tool. And generally speaking, a stock tends to trade within the Bollinger Bands 95% of the times. In instances where it jumps out of the Bollinger Band, it quickly reverts back. So if you see right here, back in November, it jumped out of the Bollinger Band here on the upside. And then as you can see in the days to follow, it quickly reverted back inside. And then same thing right here on November the 25th, it made this wick and then jumped out of the Bollinger Band on the downside, and then the day after it quickly reverted back and jumped back inside. So keeping that in mind and the fact that Nvidia is close to the bottom of its Bollinger Band, I look at that as a strong level of support for Nvidia and would possibly like to see a bounce off this level as confirmation to enter into leaps play. So keeping that in mind, let's pull up the options chain, and I'm going to go out 368 days to the December 18, 2026 options chain. And generally speaking, anytime I pick leaps options play, I target a delta of anywhere from 70 to 80, with the 75 delta being the sweet spot. Now keep in mind, the higher the delta, the safer the play, but it's obviously going to cost you more to go deeper in the money. So keeping that in mind, let's look at some of the deltas and how much premium we would have to pay to open up one leaps play for Nvidia. So if I look at the 70 delta right here, this has a lot of open interest and volume. So I like this options contract right here. And then this 70 delta is actually the 160 strike price, which gives you about a $16 discount to the current price of Nvidia. So this is one of the options that could work really well. And then right now going with this option would cost you about $4,300 for one options contract, which again will let you control 100 shares. Now another strike price that I also like is the 150 strike price. The 150 strike price is a delta of 0.75, so slightly deeper in the money compared to the previous selection. And as you can see right here, this has the highest open interest compared to some of the other selections right here. So I like this 150 strike price for Nvidia. And if we buy one leaps options contract at the 150 strike price, so this would set us back by about $4,900 for one options contract. So going back to the Nvidia chart, my first target if I were to enter into a leaps play for Nvidia would be actually this 52-week high of 212.19. So let's pull up the options calculator. Now as you see right here, I have the December 18th 150 strike price selected. You can see right here the net debit is $4,927. Basically that's how much it would cost to buy one leaps options contract at the 150 strike price, going about 368 days out from today. So keeping that in mind, I mentioned that my first price target would be Nvidia's 52-week high, which was around the 212 mark. So obviously today is Monday, December the 15th, and let's say I assume that by March of next year, Nvidia is able to get close to the 52-week high, which is a $212 strike price. Then in that case, you would end up making almost $2,500, which if we switch the chart to percentages, that would be a 50% return on your investment. Again, because one leaps options contract costed us about $5,000. So, if Nvidia were to reach the 212 strike price by March the 3rd right here, then you would have a 50% return on your investment. Now, in case Nvidia were to continue moving higher and gets to the 221 strike price, which is about a 25% upside to today's price, then in that case, you would make $3,251, which again, if I convert it into a percentage, that would be a 66% return on your investment. My next pick is Robinhood, ticker symbol HOOD. And if you check out Robinhood's 6-month chart, Robinhood has also been under pressure over the past few weeks. One of the reasons for the decline is the fact that crypto's been pulling back in the last few weeks. And obviously with the decline in the price of crypto and less people trading it, it impacts as Robinhood derives a bunch of its revenue from cryptocurrency trading. In addition to that, the stock also slid after a November operational update revealed month-over-month declines in key categories, including a 37% 7% in equity trading volumes. However, I do believe in the company long term and the value that it provides, and it continues to innovate and launch new products, operates with a 50% profit margin. In fact, if we see right here that despite the recent price drops, Cathie Wood's ARK Investment Management treated the weakness as a buy the dip opportunity, purchasing over 30 million shares of Robinhood over the past few days. Robinhood also has a key event scheduled for tomorrow, December the 16th, to officially launch new features of a yes or no prediction product market, which analysts expect could significantly impact the sports betting sector. Coming back to Robinhood's 6-month chart, it's trading in between the middle and the bottom of the Bollinger Band and slightly under the 100-day moving average. So my ideal entry for Robinhood for a leaps play would be the bottom of this Bollinger Band right here at around the $104, $105 strike price. Also, if you look at the RSI or the relative strength index, the RSI is close to 38 right now, and 30 is considered oversold. So if Robinhood does continue to move downward and get close to the $105 strike price, then in that case, the RSI will continue to fall further and probably get closer to the oversold levels. And that would make an ideal entry for a leaps play into Robinhood. So looking at the options chain, I'm going to go out 368 days to the December 18th, 2026 options chain. And let's look at some of the strike prices in a delta range of 70 to 80. So if you look at the 105 strike price, that is a delta of 70 and it has a lot of open interest. So this would be one of the good options to pick up a leaps play. And then if you go with the 105 strike price, so this would cost you about $3,600 for one leaps options contract going about a year out. However, if you look at the 105 strike price, it's only about a $10 discount from the current price. So I'd like to be a little safer and go deeper in the money, especially considering that if Robinhood actually does come down to the 105 strike price, which is the bottom of the Bollinger Band, I'd like to be a little deeper in the money and have a little more cushion. So keeping that in mind, I like this $90 strike price right here. This also has a decent amount of open interest, and obviously since this is a delta of 77, this would cost us a bit more. So if I go with this options contract right here, this would cost me about $4,325 for one leaps options contract going about a year out. So going back to Robinhood's chart, if I enter into a leaps play on Robinhood, my first price target would be Robinhood's 52-week high, which in this case is closer to the 153, 154 strike price. So let's pull up the options calculator, and I have the Robinhood December 18th, 2026 90 strike price options contract loaded here. As you can see, this would cost us about $4,325. If Robinhood is able to get to its 52-week high, which was around the 153, 154 level by, let's just say, March of next year, then you would make almost $2,900. And in case a Robinhood continues to move upward and gets to the 161 strike price, then you would make $3,601. So if I switch this chart to a percentage, as you can see, if it gets to the 153 strike price by March the 3rd, then that would be a 67% return on your capital. And then again, if it goes higher to the 161 strike price, it would be an 83% return on your capital. My final pick for this video is one of my favorite stocks to trade, SoFi Technologies. If you look at SoFi's 6-month chart, it's very close to the bottom of its Bollinger Band, with SoFi actually falling 5.68% today. Now, SoFi has been declining with the rest of the market over the past few days, as well as on the news of a 1.5 billion stock offering that it completed last week. Now, the goal of that stock offering was to raise money for SoFi's continued growth and expansion. So while the stock offering has been completed, I believe it may take SoFi a few more days to find its footing and get to a support level. And in this case, looking at SoFi's chart, I like the bottom of this Bollinger Band as a strong support level. As you can see that the bottom of the Bollinger Band is close to a $25 strike price. And as you see right here, SoFi got to this level earlier in November, on November the 21st, and then bounced right off it. And then earlier back in October too, it got to this $25 level and then bounced back. So I believe that if SoFi gets to this $25 level, that would make a great entry for a leaps play. Also looking at the RSI, SoFi's RSI is 37, with 30 being the oversold level. It's very close to oversold levels, meaning that if SoFi were to actually come down to the $25 level, then the RSI would fall further and it would likely make a good entry for a leaps play. So let's pull up the options chain. I'm going to go out again to the December 18, 2026 options chain, and looking at some of the deltas right here. SoFi ended the day at 25.72. And if you look at some of the strike prices right here, the $23 strike price is a delta of 72, we have a decent amount of open interest here, and going with this selection would be about $865 for one Leaps options contract. Now, I also like this $20 strike price, and it gives you about a $6 discount from the current price levels, and this is a delta of 79, which is nicely deeper in the money compared to the $23 strike price, and obviously it's about a $6 discount from the current price level. And because SoFi is not a very expensive stock, I would actually go with the 79 delta because this would only cost us a little bit more. So going with this options contract would only cost us about $1,000 for one Leaps options contract. So let's pull up the SoFi 6-month chart again. And if we see right here, SoFi made a 52-week high of 32.73 back in November. So that would be my first target if I enter into a Leaps play for SoFi. So keeping that in mind, let's pull up the options calculator. So I'm gonna go ahead and load up SoFi right here, and then we're gonna go to the December 18th, and then we're gonna go with the $20 strike price, and the $20 strike price would cost us about $1,000 in net debit. As I mentioned, SoFi's 52-week high was around 32.73. So let's just say we go with the rounded number, which is $33. So let's say if SoFi were able to get to the $33 strike price by March of next year, then you would make $528 on your investment. And again, as you can see clearly, that would be about a 50% return on your investment. In case we get another interest rate cut in January, which right now I believe there's about a 75% chance of an interest rate cut in January. Now, because 55% of SoFi's revenue comes from its lending division, an additional interest rate cut in January is likely to benefit SoFi. So that should certainly help support SoFi's upward movement at that point. And if that happens and SoFi continues to move upward, and let's just say it gets to $35 by March, then you would make $705 on your investment. And again, if I switch this chart over to percentages, you can see right here that if it gets to the $33 strike price, which is its 52-week high, that would be a 52% return on your investment. And if it actually moves forward and goes to the $35 strike price, then you would make a 70% return on your investment. So that's it for this video. If you enjoyed it or learned anything useful, please be sure to click the like button, subscribe to my channel, and comment down below with your thoughts or questions. If you would like one-on-one coaching with me or be part of my Discord community, click on the first link in the description below, and I'd love to help you out. I'll see you in the next one.